Every bull run, millions of new investors flood into crypto. And every single time, most of them leave with less than they came in with. Today we're breaking down the top 5 reasons why, so you don't become a statistic. Reason 1: FOMO and panic selling. The first killer is emotional reactivity, and it comes in 2 phases. Phase 1: FOMO. When prices are pumping and everyone online is talking about their gains, new investors jump in near the top. Not because they've done research, but because they don't want to miss out. Phase 2: panic. When the correction hits, and it always does, those same investors have no strategy, no conviction, and no plan. So they sell at a loss, lock in the damage, and swear off crypto forever. The market didn't beat them. Their emotions did. Reason 2: volatility and poor risk management. Crypto is not the stock market. Swings of 10%, 20%, even 30% in a matter of days are completely normal in this space. That's not a bug, that's the nature of a 24/7, globally traded, highly speculative asset class. The problem isn't the volatility. The problem is that most new investors have no risk management framework. They go in with no stop-loss orders. They over-leverage, meaning they trade with borrowed money, and one bad candle wipes out their entire account. If you don't know your exit before you enter, the market will make that decision for you. Reason 3: scams and fraud. Here's a number that should stop you cold. In 2025 alone, Americans reported $11.4 billion in crypto-related fraud losses to the FBI, a 22% jump from the year before, making it an all-time record. Yahoo Finance. Investment fraud alone drove over $7 billion of that, the single largest category of financial cybercrime in the country. The Street. New investors are the primary target. Rug pulls, fake platforms, pig butchering scams, AI-driven phishing, the sophistication of these attacks has never been higher. If a project is promising guaranteed returns, if someone you met online is guiding your trades, or if the opportunity sounds too good to be true, it is. Reason 4: no fundamental research. This one is uncomfortable, but it needs to be said. Most new investors don't read white papers. They don't analyze tokenomics. They don't ask who's building the project, what problem it solves, or whether the token actually needs to exist. Instead, they ape in based on a tweet, a TikTok, or a celebrity endorsement. And then they're shocked when it goes to zero. The data backs this up. Roughly 85% of tokens launched in 2025 are now trading below their initial valuations, with the median token down more than 70%. 4 out of 5 launches were wealth destruction events for retail buyers. The only ones who survived were the ones who did their homework before they put in a single dollar. Reason 5: macro and regulatory pressure. The final reason isn't about what's happening on chain, it's about what's happening in the world. When interest rates rise, when inflation spikes, when the dollar strengthens, risk-on assets like crypto become less attractive relative to safer alternatives. Institutional and retail money rotates out, and prices fall. On top of that, regulatory uncertainty creates fear. When governments hint at restrictions, when legislation like the Clarity Act is debated without resolution, investors who don't understand the space panic and sell even when the actual legal risk is low. The investors who stay are the ones who understand that macro cycles are temporary, and that fundamentally strong projects survive regulatory noise. Outro. So there you have it, the 5 real reasons new investors exit the market. Emotional trading. Poor risk management. Falling for scams. Skipping research. And letting macro fear make their decisions. None of these are inevitable. They're all avoidable with the right education and the right mindset. If this video helped you, drop a like, subscribe to Flow Money, and share this with someone who needs to hear it before they make a costly mistake. See you in the next one.